Welcome back to the Daily Crypto Roundup. And today we've got one of those market days where the surface looks calm, but underneath it there is actually quite a lot going on. Price action itself has not been explosive, but the stories shaping sentiment are important because they tell us what kind of market we are in right now. We have got a much stronger than expected US jobs report, which matters because that feeds directly into the Federal Reserve conversation and therefore into liquidity expectations for crypto. We have got the Ethereum Foundation taking another major step in its staking plan, which is one of those quieter stories that can still shift sentiment around Ethereum over time. We have got a broader crypto market that has gone a little flat on the surface while futures and options traders still seem defensive underneath. And then we have got Microsoft announcing a huge $10 billion investment into Japan's AI future, which at first sounds like a pure tech story, but in reality tells us a lot about where money, infrastructure, and digital power are flowing next. We're also excited to say that Kraken is now the official partner of the show. That matters because we only want to work with brands that actually fit what this channel is about, and Kraken is one of the biggest and most established names in crypto. So if you're looking for a place to buy, sell, or manage your crypto, you can check them out through our link in the description. It helps support the show, helps us keep building this thing bigger every single day. And it means a lot when the community backs the partners that back us. Anyone that signs up using our link will receive 20 XRP to their newly created Kraken account. Just send us a DM on X, and we will get that sorted for you. Now moving back to today's stories. Let's start with the macro story, because whether people like it or not, macro still sets the tone for everything in this market. The United States added 178,000 jobs in March, which was much stronger than expected. Forecasts had been much lower, so this came in as a genuine upside surprise. The unemployment rate came in at 4.3%, wages still rose, and sectors like healthcare, construction, and transportation all helped push the number higher. On the surface, that sounds like a very healthy economic signal. If jobs are still being created at that pace, then the economy clearly is not falling apart. Now, normally, strong economic data sounds like something markets should love. A strong labor market should mean confidence, spending, and stability. But the problem for crypto and other risk assets is that strong economic data also gives the Federal Reserve less reason to cut rates quickly. And that is where the tension comes in. A lot of investors still want easier monetary policy, lower rates, and a more supportive liquidity environment. So when a jobs report comes in stronger than expected, it can calm recession fears while also making traders think the Fed might stay tighter for longer. That is why this jobs report is not a simple bullish story for Bitcoin. It is supportive in one sense because it says the US economy is still standing up better than feared. But at the same time, it may reduce the odds of rapid policy easing, and crypto has always been highly sensitive to that liquidity question. In other words, this is a report that helps confidence, but may not help the kind of easy money narrative that many traders want. That is why the market response to strong jobs data is often more complicated than people expect. Good news for the economy can become mixed news for risk assets. There was also some nuance under the surface of this report. While the headline number was strong, some of the strength may have been helped by temporary factors. Some workers returned after a healthcare strike, and better weather likely helped construction activity as well. The average work week also slipped a little, which suggests the report was not flawless under the hood. So this was not a perfect all-clear signal. It was more like a reminder that the economy is not cracking yet, even if there are still softer details in the background. For crypto, the clean takeaway is this. The report reduces immediate recession fear, but it also reduces the case for urgent Fed cuts. And that leaves Bitcoin and the wider market stuck in an awkward middle ground. If the economy is okay, that should stop the really dark panic scenarios from taking over. But if the economy is okay enough to keep the Fed on hold, then the next wave of liquidity may not arrive as quickly as some people hoped. So traders are left trying to figure out which side matters more. Is resilience enough to keep this market stable? Or does the lack of easy money stop the next big move from happening? That question really hangs over the whole market right now. Now let's move over to Ethereum because this was one of the more quietly positive stories of the day. The Ethereum Foundation has now taken another major step toward staking around 70,000 Ethereum from its treasury. The latest move involved another large tranche of it being staked, bringing the total very close to that target. This matters because it changes the conversation around how the foundation manages its assets. Instead of relying as heavily on future sales to help fund operations, staking allows it to earn yield directly from the network itself. That may sound like a small treasury management detail, but it actually matters more than people might think. One of the recurring criticisms around Ethereum has been the idea that major institutions connected to the network could become a source of sell pressure when they need funding. This move does not eliminate that concern completely, but it does help soften it. If more of the foundation's treasury is being staked and generating rewards, then there is less pressure to think of those holdings as dormant assets waiting to be sold later. That is good for sentiment, even if it does not immediately change price action. It also sends a confidence signal. The Ethereum Foundation is not rotating away from Ethereum or sitting passively on the sidelines. It is putting treasury capital to work directly inside Ethereum's own security and yield system. That is meaningful because actions often say more than words. If the institution closest to Ethereum is willing to commit that kind of capital into staking, then that reinforces the message that it still believes in the long-term strength of the network. It shows alignment, it shows commitment. And in a market that is always looking for signs of conviction, that matters. Now, this is where it is important not to overdo the hype. This is not some giant event that suddenly forces Ethereum to rip higher overnight. It is a constructive background story, not an immediate moonshot catalyst. Ethereum still has to deal with broader market conditions, risk appetite, macro pressure, and competition from other chains and narratives. But it does improve the medium-term tone around the asset. It helps shape a slightly more bullish narrative about treasury discipline, reduced sell pressure risk, and institutional confidence in Ethereum's staking model. So, if you are trying to read the deeper message here, it is this. Ethereum is getting a subtle but real structural boost. The foundation is showing that it wants to generate yield from the network rather than simply hold large passive balances. That makes Ethereum look more mature, more self-reinforcing, and a little more efficient from a treasury point of view. Again, it is not the kind of story that dominates a whole market cycle on its own, but it is the kind of thing that becomes important when people look back and ask what was quietly improving beneath the surface. Now let's zoom back out to the wider crypto market, because this is where things get really interesting. On the surface, crypto has gone a bit quiet. Bitcoin has been holding in a relatively tight range. Volatility has cooled off, and there is not the same sense of wild movement that you get during a full-blown breakout or panic. But when you look underneath, the mood in derivatives market still looks cautious. This is not a market that seems eager to scream higher. It is a market that looks calm, but still wary. That distinction is important. Low volatility can sometimes be a good thing because it can signal stabilization after chaos. But low volatility can also mean indecision, low conviction, and a lack of strong buyers willing to push the market forward. Right now, it looks more like the second version. Futures activity has been relatively muted, which suggests traders are not aggressively leaning into a strong bullish move. At the same time, options traders still seem willing to pay more for downside protection than upside exposure. That tells you a lot about the psychology of this market. In plain English, traders may not be panicking anymore, but they are not exactly trusting the bounce either. They are no longer shouting, but they are still standing near the exit. That is the best way to describe it. Calm has returned, but confidence has not fully returned with it. And that matters because the strongest rallies usually happen when markets shift from fear into genuine belief. At the moment, we seem to be somewhere in between. There is less fear than before, but not enough optimism yet to create a powerful upside trend. The Solana side of the story adds another layer to this. Futures data showed more open interest building in Solana while funding rates stayed negative, which suggests that bearish positioning was becoming more aggressive there. In simple terms, more traders were leaning short than leaning long. That does not guarantee the market will drop, because crowded short positioning can always become fuel for a squeeze. But it does tell you that a chunk of the market still sees more downside risk than upside opportunity right now. That lines up with the broader defensive tone we are seeing across the derivatives landscape. So the crypto market today feels like a market in waiting. It is not collapsing, but it is not convincing either. It is stable enough to stop people from fully panicking, but not strong enough to get everyone excited again. That kind of environment can continue for a while, especially when traders are stuck between mixed macro signals and a lack of obvious fresh momentum. The bulls do not have complete control, but the bears do not look unstoppable either. It is more like a standoff than a trend. And that brings us to the final story, which at first might seem slightly outside crypto, but I actually think it matters a lot. Microsoft is investing $10 billion into Japan over the next few years to expand AI infrastructure, strengthen cybersecurity cooperation, and help develop more local talent. On paper, that sounds like a straight big tech expansion story. But underneath, it is really a story about where long-term digital power is being built. And that has implications far beyond Microsoft itself. Now the question is, why does this matter for you? Because it tells you that the AI capital race is still alive and moving at enormous scale. There has been a lot of talk recently about whether the AI trade is overheating, whether hyperscalers are spending too aggressively, and whether investors will eventually get tired of these huge infrastructure commitments. But when Microsoft comes out and puts $10 billion into one country's AI and cyber future, it tells you the biggest players still see this build-out as strategically essential. They are not backing away. They are digging in. It also tells you that this is not just about software or chatbots. This is about compute, cloud dominance, local infrastructure, trust, cyber resilience, and long-term influence. Japan clearly matters here not only as a market, but as a strategic partner in the next era of digital systems. And that is what makes this more than a normal corporate investment headline. It is part of a wider pattern where nations and major companies are shaping the infrastructure that future digital life will run on. There is also a sovereignty angle to all of this. More countries increasingly want trusted digital infrastructure on home soil, or tied closely to domestic interests. They do not just want access to AI. They want secure compute, local capacity, trusted hosting, and stronger control over their own digital future. That matters because it shows how the next phase of technology is not being shaped only by open global markets. It is also being shaped by national priorities, strategic alliances, and security concerns. Crypto exists inside that same wider world, so it cannot be looked at in isolation. For crypto, that creates both a challenge and an opportunity. The challenge is obvious. Huge amounts of traditional capital are still flowing into AI infrastructure and centralized digital power. That means crypto has to compete for attention, capital, and narrative strength. But the opportunity is that the more the world becomes dominated by highly strategic, tightly controlled digital systems, the stronger the long-term argument may become for open, decentralized alternatives. So even though Microsoft's investment is not a crypto story directly, it still sits inside the same bigger battle over the future of digital trust and digital control. When you put all four of these stories together, the bigger message becomes much clearer. We are in a market that is calm on the surface, but still unresolved underneath. The US jobs report tells us the economy is stronger than feared, but that same strength may delay the easier monetary conditions that crypto loves. The Ethereum Foundation staking move tells us there are still meaningful constructive developments happening inside the ecosystem, even if they are not flashy. The derivatives data tells us traders are calmer but still defensive. And Microsoft's Japan announcement tells us that outside crypto, massive strategic capital is still pouring into the future of digital infrastructure. That is why I would not call this a boring day. It may not have had the most dramatic candles, but it told us a lot about the tone of the market. Right now, that tone feels cautious, selective, and very aware of macro. It is willing to acknowledge positive developments, but not willing to trust them too quickly. It is not in full fear mode, but it is definitely not in easy euphoria mode either. It is the kind of market where a single powerful catalyst could wake everything up very quickly. But until that catalyst shows up, traders are likely to stay tactical and headline sensitive. So the bottom line today is this. Crypto looks quiet, but the quiet is deceptive. Underneath it, there is still a live battle between resilience and hesitation. Strong economic data is helping confidence while also keeping pressure on the Fed narrative. Ethereum is showing signs of quiet structural improvement. Futures traders still look defensive. And the world outside crypto is still throwing billions into the infrastructure race that will shape the next digital era. That is the environment we are trading in right now. Stable, cautious, and waiting for something bigger to force the next clear move. And before we wrap up, a big thank you to this incredible community for all the support you've been giving the show. With it being Easter, we wanted to give a little something back, so this week we're giving away 4 lots of XRP. Andre Lengel is getting 5 XRP, Moonhead is getting 10, Ryan84 is getting 10, and King John III is getting 5, so congratulations to all of you. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.